We were deciding between mobile home parks and storage. We ended up selecting storage, honestly, because people don't live there. That was attractive to us. Self storage, to some extent, is a little insulated from rent control laws and some of the headaches that tenants that live in houses may cause, especially in affordable housing. So we chose storage and did a pilot, bought our first facility, and we haven't looked back. We're still going now.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is Frank Scappaticci. He's a partner and co-founder of Gray Line Investments. He's a West Point graduate and former Army football team captain. Upon graduating from West Point, he completed U.S. Army Ranger and Airborne School, deployed to Afghanistan and Kuwait. As a captain, he served in a brigade fire support officer for 2-4 Indiana Division. He transitioned in financial services in 2014, Ernst & Young and JP Morgan. 2018 discovered an interest in real estate and started buying single-family rentals. In 2020, he founded Gray Line Investments with his partner, John Plumstead, and they bought, sold, brokered over 150 homes. And in 21, they decided to go full-time, and they focused on self-storage. And then they are, you're going to hear him, talk about self-storage and what's changed over the last number of years. And, we're going to talk about self-storage versus, what's happening in the market right now. But then also, he's going to lay out a few tips raising money that I thought were really good. And I just feel like some of these things you hear me talk about it. If folks just implemented some of these things right away, you're going to be able to raise more capital for your deals. Frank, welcome to the show. Honored to have you, honored to meet you. And first and foremost, I want to thank you for your military service. I just have the utmost respect for our servicemen and women. So grateful for that. Just right off the bat, I want to thank you for your service.
Well, thank you, Whitney. I'm excited to be here. Thank you for your service as well. I'm pumped. It's going to be fun.
Yeah, no, looking forward to it. I know you have a diverse background, and I want to dive into that a little bit. But you have focused on self-storage now, and so I want to hear the state of self-storage, right? Because I know that's what listeners are wondering about as well. Is there a passive investor looking to invest in that asset class, or maybe they're an operator, that's growing in self-storage as well? So I want to get to that. But before we do, man, tell us a little more about Frank. How did you get there? A little bit about your background. I relate to you, obviously, in the military background in a big way, but that shaped a lot of who I am now, right? And even my entrepreneurial drive to some degree, some of those things. So I'm interested to hear, maybe how that shaped you, but then some of your more professional, after military background as well.
I'm a New Yorker by trade. That's where I hail from. And you're right. I did commission into the Army as a lieutenant in 2009, deployed twice, once to Afghanistan and once to Kuwait. That was all between 2011 and 2014. Which is a great experience, as you are aware of. And during that time, you have a lot of people that are doing VA loans. I eventually used a VA loan to get my primary residence, and that's like the true like low and no money down strategy, right? Like there's like books on that stuff, but the VA loan is like probably the best low and no money down thing.
You may
And
have to risk your life to get it done, though.
Yeah, you gotta pay Uncle Sam, right? So there's a cost, but it is a great loan product. And I think I only put down like 3 to 5% on my primary residence or something like that. At like now I refinanced and my interest rate's like 3 flat, right? So it's an incredible loan. That was my first exposure to real estate, and I was like, "Oh, this is cool. This is awesome," right? Then I bought a couple rentals outside of Fort Hood, Fort Sill, for which are Army bases, and then my business partner called me one day. His name's John Plumstead, and he's like, "Hey, do you want to start doing this together? Like, do this whole real estate thing?" I said yes. We started hustling single family houses, did a ton of deals, wholesaled some houses, kept some rentals. Long story there. And then at some point, just over 2 years ago, we said, "Hey, let's try to graduate, move into a more efficient asset class, maybe try to invest in some more long term investments and get some more appreciation than a house in Fort Sill." And we landed on storage. We were deciding between mobile home parks and storage. We ended up selecting storage, honestly, because people don't live there. That was attractive to us. Sounds kind of crazy, but self-storage, to some extent, is a little insulated from rent control laws and some of the headaches that tenants that live in houses may cause, especially in affordable housing. So we chose storage and did a pilot, bought our first facility, and we haven't looked back. We're still going now. So that's how we got into it.
Yeah, no, that's awesome. And Tell me, let's jump into though, and with your focus on self storage again, I know so many have are wondering, right? What is the state of self storage? Give us more of a, I guess, economic climate update. From your opinion, just on that asset class.
Well, self-storage has changed a lot. If you went back 7 to 10 years ago, you're just looking at a very fragmented asset class. What does that mean? It means the vast majority of the assets are owned by mom and pops or individual owners. And over the past 10 years, it's still kind of like that, but it's been changing a lot. So I think the last time I checked, we're still like hovering around 50% like private equity or institutionally owned storage, and like half the storage is essentially owned by mom and pops, but that number's changed a lot. So there's a lot of consolidation happening in the industry. What does that mean for pricing? Well, it means prices are going up, right? Like the more capital that's flowing into the asset class, the more the cap rates are compressing, the more lenders are also jumping in too, right? And all this stuff has caused asset prices to get pretty high. And the thing that's interesting is the interest rate hikes have caused multifamily pricing to go down, right? Multifamily is down 12 to 15%. Storage pricing has remained very resilient. I spoke to a broker last week in New York City, and he said, even for tertiary storage, if I price it at a 6.75 cap, it sells immediately. Like it's gone. And we look at every deal that hits the market, and I would say that that's true. And a lot of times I'm seeing tertiary stuff trading at 6.5. So we haven't been able to buy a lot because you have to go all off market in this type of environment to make anything pencil. So the state of self storage is it's resilient right now in terms of asset pricing for sure.
You mentioned you have to go off market. I guess speak to how you're doing that, or what does that look like as far as going off market? Obviously, direct to seller.
So our direct to seller marketing is we use direct mail as our primary, and we're primarily focused on Florida and Georgia right now. It's more targeted than that, but I'll just say Florida and Georgia. And we had a cold caller working 24/7, not 24/7, but 40 hours a week. And they came up with a good list of leads. But at this point, we're just nurturing those, my partner and I. Reason being is there's just not that many storage facilities compared to other asset classes. There's only about 50 to 60,000 of them in the country. So we're really only looking at, let's say a couple thousand. So the prospecting it's just not that big of a sales funnel, honestly.
Yeah. And that's a pro and a con, I guess, right? Both sides of that. That could be a negative or a positive, but man, at least it sounds like though you all have that list now and you're focusing on the relationships, right?
Yeah, we're nurturing them along. It's I agree with what you said. It's good and bad. It makes it easy to prioritize who you want to talk to, but the problem is everyone else has that advantage too. So every
Yeah.
broker and competitor, and some of them are our friends, have also called those owners. So it is extremely competitive.
Speak to the financing component for self storage, and what does that look like now for or in that asset class, since the interest rates obviously have changed a little.
Yeah. So two of our three last deals have either been seller financing or cash. But the last time we did go to market for debt was in January, and our loan was 6.5% interest. It was either 20 or 25-year AM. I'm actually forgetting. They didn't give us an IO period, so we were paying principal right off the bat, and it balloons in 5 years, I think. So the rate's 6.5. A year ago, we were borrowing at 4.25. So it's pretty big change.
Yeah, yeah, for sure. Do you see? I don't know. As you all are assessing deal flow right now, how are you accounting for maybe interest rates a year from now?
I mean, we don't know what rates are going to do. I think
Sure.
there's all these different like websites you can go to see what Wall Street's saying is going to happen, and there's people placing bets on it. And from what I can tell, it looks like they're going to stay a little bit higher for a little bit longer than people will think, but they're probably leveling out sometime soon. That's what the betters of the world are saying. How we're responding is we're trying to focus more and more on levered yield on cost as our guiding principle. And really, what does that mean? That's, hey, imagine you don't have a mortgage, and what is your ROI or yield on the money you put into the deal? That's unlevered yield on cost, because that number is independent of what happens with interest rates. So it's easier for us to use that as a guiding principle when interest rates are extremely volatile. So that's something we're doing.
Yeah. Well, speak to your, I guess let's dive into some of your ability to raise capital right now. That that's changed a lot right now for a lot of people in our industry, almost everyone.
Yeah.
And so, but sometimes, in a time like this, when things get a little more challenging, we learn a lot, right? You either choose to learn a lot or you don't, I guess, and improve, or you get taught some hard lessons or worse lessons maybe. But at the moment, I just constantly hear everybody talking about how, it's more difficult. But so what's been your path right now to being able to consistently raise capital as needed?
I mean, our path at our first deal we syndicated, it was mostly filled with people we had worked with in our single family days, like private money lenders. I think my brother was in, and I had one friend. The rest of it was all like single family folk that we had worked with. It's evolved since then, to there's a bigger share of more like professional commercial real estate LPs, people that invest in multiple deals with multiple sponsors. And now that makes the majority of our capital. So who invests with us has changed a lot. And I think anyone who does, syndications like one, two, three, four, and then five follows that trajectory. But to your point, is it getting harder? Yes. Right. So even I keep track of our conversion. Like how many people do I talk to invest in our deals? I keep track of it. And when we had no track record, this is like late 21, 22 timeframe, we were batting like 70%. Like if I spoke to someone, they contributed in some form or fashion to a deal. We get some track record. We actually go full cycle on a deal. And the last deal on my raise, I was batting like 35%. It was a good deal, right? Like solid deal. Why? I think people simply have less discretionary income or money, and there's definitely more fear in the market or negative sentiment. So, what does that do for a capital raiser? Well, you're going to have to cast a wider net to hit the same results, unless you just get lucky, right? So, I think conversion for fundraisers is down. And as a result of that, you're seeing some sponsors move their terms. We haven't really moved ours very much, but they're moving their terms in LP's favor. So I've seen people with 6% preferred returns move it to 7 or 7 to 8, which is, I think, where the market kind of settles, is like 8% is pretty normal. And they're moving their promotes back to what was probably normal in 2017 and 18.
Yeah. Or anything you're doing, you mentioned like casting a wider net. What ways are you all maybe doing that or getting more people in your funnel?
We have a mailing list or email list we nurture, that's got a couple of thousand people on it. We also use Twitter. Twitter is getting harder, I think, for organic reach, but we still use it. I have a small account or small following. So does my partner. So we made friends and made some acquaintances from there. And then after that, it's a lot of word of mouth. People from our first deal that had a solid exit go talk to their buddy, their uncle, aunt, whomever, and you get some organic word of mouth right there.
You mentioned, this email list, couple thousand people on it. It's difficult to gain a couple thousand people unless you go buy a list or something, right? But speak to how maybe you grew even your email list to a few thousand people.
Well, one thing I will say is this is where being, a veteran or someone in the military did help, because we started telling people in our West Point network, we're West Pointers, like, hey, we're starting this business and we're excited about it. And we got a pretty decent bump in subscriptions just from that, because there is a little bit of a sense of community coming from a small school like that. So I think that did help. So that probably got us like a couple hundred right there. We used to wholesale houses too, and wholesalers are essentially like really scrappy marketers. So we're getting also some residual effects there as well for people we had contacted. So that was a good jumping off point. And then I'd say Twitter was like the last push that got us some decent reach. So it was like a three-pronged attack, but that's how we did it.
Yeah, no, that's awesome. Speak to like somebody that's not familiar with Twitter, and I can't say that I'm extremely familiar. I mean, our team uses it, but I'm not on there very much, if at all, hardly. But give some guidance. Somebody, how have you successfully used that platform, and gained investors through that?
I think our strategy, and Nick Huber, who's got a big following, kind of told us to do this or coached us through this, because we had told him like, hey, we have to build some reach in our business. And we were just pretty vulnerable. Like, hey, this is what we're trying to do. I hope in 6 months, this is what our business looks like. We're going to just tell our story. Hey, month number one, we looked at X amount of deals. We made X amount of offers. And this is how many contracts we got. Month number one, it's 0. Right. And then you just keep updating your audience. with your experience, and people like that. People like following along that hero's journey, that entrepreneur that's like honest about their struggles. And we try to be vulnerable and just share that stuff with the world. And our followings are small, but they still matter to a certain extent. They still add value to our company. So that was basically it.
I think often, we struggle. We think we struggle to come up with content, right? But if you are documenting your journey, there's typically things all the time you could talk about, right? Is that what you found?
Yeah. There's always something like a contract that you have to terminate, a deal that's going well, right? A property that turns around fast, or one that you're driving occupancy and you wish it was going faster. Like there's always something going on in the business. I think actually the biggest challenge for me is sometimes I want to post something and I get scared because it's like vulnerable or it makes me nervous. And when you have that feeling, it's almost always true that you should press the button, like that those are the things that actually get you the reach in fundraising, but it is scary, like you get scared. So I think the moat, or like where you separate yourself, is like kind of leaning in and taking on some of that risk, and be willing to be wrong in public. I think if you're the influencers do that. I'm not an influencer, but that's what they do.
What we think about the future affects what we do now, right? And so, are the decisions we're making. So, do you have any predictions on just what you expect to happen in the real estate market? And it can be self storage specifically, but just in the economic climate in general over the next 6 to 12 months.
Like asset classes behave differently, but they're still somewhat related. Like I think as cap rates continue to expand in office and multifamily, you'll probably see money flow there, right? Because right now industrial storage are very, very hot. So I think it's fair. I think you have to be willing to underwrite with some cap rate expansion on storage and industrial, which is what we're focused on right now. Let's say it's like 25 bips or 50 bips, and then pressure test it from there, right? Like have a bad scenario, like way worse than that. So I think you have to do that. But as far as storage goes, I think we've already seen significant drop in customer demand. And if you're still doing well today, like I think you're in good position. Moving volumes are way down. That's a big demand driver for self storage. Really, really big. I think it's like 20% of our customer base is moving, and no one's buying homes. So that we've already seen rates go down. So I think storage is going to start to level out. And my theory there is that shorter lease duration real estate will feels the market effects of these rate hikes first. And the longer the lease, the longer it will take to feel it. So storage, it's month to month. So we feel it right away. So I think storage will probably level out in demand, but maybe have cap rate expansion, but generally be resilient. That's my feeling.
Yeah. What about if you're buying an asset right now, just preparing for a downturn, right? What I usually say is preparing for the worst, but then something else happening as well. How do you know you're prepared for that when looking at a self storage unit right now?
Most people who get burned historically is financing. If you have maturities coming up in 24 or 25, people, I think, need to be actively coming up with a game plan. Maturing mean loans are coming due. You have a balloon payments. Like, hey, your $1 million loan is due July of 2023. You got to have a plan for that. So in our case, we fixed all of our debts, and we don't have a maturity or a balloon until 2026 on any of our debt. So I feel like we did a really good job of protecting ourselves from that risk. Like if lending dries up, we don't get caught with our pants down. So I think that's the number one way to protect yourself. And I think that's agnostic of asset class. It's everything.
What about and you mentioned the three ways you've raised money, or three specific things, but I always like to ask, what's your best source for meeting new investors right now?
It's a good question. I actually still think it's our West Point network. like if we just keep talking to these people that share this common experience, you just get introduced to more friends. Another thing I'm starting to do that I'm finding is mutually beneficial is I started contributing with a non-for-profit that's military focused, and I'm trying to stand up the New York chapter. I think I'm the first guy in New York. And you end up networking with a lot of people that are like-minded, good folk. I think that's a beneficial action too, for a fundraiser, which was kind of like a nice hidden surprise.
What about what are some of the most important metrics that you track? And that could be personally or professionally.
Oh man. Do you mean like for property or fundraising?
Either
Or
way. So I kind of leave it open on purpose. And what I typically will say, well, it could be your bench press number or how many mornings you got out of bed on time to how many properties you're underwriting, whatever you consider some of the most important metrics for you personally.
That's a great question. We measure a lot of things. I think the most important thing I measure though is I have a rule. I have to exercise 4 days a week. And then if I hit 4 out of 7, I'll try to get 5, but that's like my minimum number. I want to always get 4. It's probably the most, besides like being with my kids and my wife, it's probably the most important thing that I do or don't do, you know?
Any other habits that you're disciplined about?
I get up early, so I make time. I have a good morning routine. I like to wake up around 5:30, either exercise or read. And I'm pretty good about doing that every day. And that's it. I work from home. I wake up early. I do my thing in the morning, grab my coffee afterwards, hang out with my kids, take them to school, work every day, and that's it. I live a pretty boring life.
How do you like to give back?
This not-for-profit I joined, it's called Hero Hut. It's mainly focused on running events and co-sponsoring events that bring veterans together. I think I'm passionate about it because I got out of the army, went into financial services consulting, toiled in there for 5 years, hated it, and generally looking back, bumbled my transition. Like I never asked myself, like, what do I want to do or what am I good at? Sounds really dumb, but I think a lot of vets kind of make that mistake. So I'm kind of passionate about talking about that and trying to help people navigate that process.
Yeah. Yeah. So you're saying a lot of vets will they come home and say, what am I good at? They don't know like where to turn kind of thing.
Yeah, well, you're also conditioned. Like the army doesn't care what you're good at or bad at. It just has a bar, and you have to just go reach it. And people forget when they get out, they're overwhelmed by how many options they have, and they forget that their skills get a vote in what they do. And I think I was in that category, which is could put you in a tough place, to be totally honest. So
Yeah. Yeah. No, I can relate to that coming home and trying to figure out what do I do now, right?
it's overwhelming.
Yeah,
Yeah.
yeah. Well, Frank, I'm grateful to have had you on the show, and again, thank you for your service. And but really thinking through the state of the market as far as self storage, and what 10 years ago versus now, even some ways that you all are finding deals right now. But the reality of a small number of self-storage complexes right in the whole US, and what that takes to now go buy them, but financing, and then even some how you're going about raising money and some successful tips. Again, I just think there's a few shows even recently, and this is one of them where I feel like if a listener is listening and they just go implement a few of these things, they're going to have some success, right? It's usually the people listen and they don't actually go put some feet to it. And so I appreciate your transparency in that. How can the listeners get in touch with you and learn more about you?
I'm most active on Twitter. My handle is at Frank Scap with 2 P's. I'm on LinkedIn too. If you follow me on Twitter, I generally respond to my DMs and try to be helpful when I can.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.